Hi, welcome back to the podcast, HOA Hell. I'm your host, Michael Kushner, and with me, as always, is Senior Associate from MBK Chapman, Sam Kill. Sam?
Good morning. Good to be with you.
You too. Good morning.
Thank you.
All right, Sam, put yourself in this position for a minute. You put your condo on the market, okay? Find a buyer, great credit, healthy down payment, you're in escrow, you're in contract, as they say, deal looks done, and the loan on the part of the buyer collapses, and it has nothing to do with the buyer. It has everything to do with your HOA. Specifically, you dig in a little bit and you discover that Fannie Mae, for example, has delisted your HOA by flagging it in its system, and which we'll talk about, is unavailable.
Right.
Okay? Or if it's Freddie Mac, it'd be not eligible.
Correct.
We'll get to that. That's the scenario. You find that you can't sell your condo.
It's a terrible thing to be blindsided by. Yet it happens all the time.
It happens a lot, especially now. It's happening more and more now. And we're going to talk, I'll get into, well, let's do it now. Today, we're going to talk about Fannie Mae and Freddie Mac delisting. When we use the term delisting, that's a colloquial term. The more formal term, at least if you're talking about and we'll get to the specifics in a couple of minutes, but we're talking about the Fannie Mae system. It's being your property, your HOA, not your individual condo, but your HOA, your community, is listed as unavailable. If your property falls under a Freddie Mac scheme, which again, we'll talk about why it might and the difference, then it would be listed as not eligible. But both of those mean the same thing. They just use different terminology. And when I say delisted, I'm talking about both. Okay. So that is a problem that's happening a lot right now. And some of it is traced to the balcony law, which we've spoken about tremendously in the last few episodes and in general throughout our entire run of this podcast. So just to let you have an understanding of how big a deal this is, let me give you some statistics now, and then as this show progresses today, you're going to see why it's such a big deal. Between May of 2023 and March of 2025, the number of condo projects flagged by Fannie Mae, and I don't know if this number includes Freddie Mac also, I just saw Fannie Mae in this statistic, it did include both. So the percentage jump just in the last few years, and this was up through March of 25 when this statistic came in, jumped 329%.
Wow.
329%. Now, of course, if there was only two HOAs that fit under that, and then in that 3-year period it jumped to, what, 6 or something, then yeah, that wouldn't be a big deal.
Well,
but we are talking about a lot of HOAs, okay? So today, Sam and I are going to walk you through what this flag is, this flag of unavailability or not eligible, what it is, why it's such a big deal, and most importantly, can your HOA dig its way out? And we're going to talk to you about those consequences. So let's first talk about unavailable and not eligible. Again, the latter is for Freddie Mac and the former is Fannie Mae, but it's same thing. Behind every condo sale, almost, unless we're talking about a non-conforming loan, so a really, really high-end condo that's like $2 million, or if somebody's paying cash, okay? Behind almost every condo sale in the state of California sits two names, Fannie Mae, Freddie Mac. Fannie Mae and Freddie Mac are the two big government-sponsored enterprises that sit behind most conforming loans, okay? And they run their own separate review systems. Fannie Mae tends to, and I'm going to use the word back loans, but it's really kind of a misnomer I'll get to in a second. But Fannie Mae backs loans for colloquial purposes from the larger banks, and Freddie Mac from the smaller, maybe more regional banks. But other than that, they accomplish the same thing. They do the same thing, okay? Here's how it works. A lender writes your mortgage. They actually lend you the money. They do the credit check, all that stuff, okay? You use, that money goes into escrow. It's used to close escrow to buy the house, okay? So now you've got a mortgage. Immediately, if the loan falls under the rubric of Fannie Mae or Freddie Mac, there's a bunch of rules, and these loans are packaged a certain way. That's what their underwriting does. That person that gave you the mortgage it wants to do what we're about to talk about. So they take very special care to make sure that they're following all the rules for Fannie Mae or Freddie Mac, whoever they're going to be selling to. But basically, that loan is sold immediately. So the mortgage funds, it's sold, it's bundled and sold to, let's say we're talking about Fannie Mae, sold to Fannie Mae. Fannie Mae bundles that and a bunch of other similar mortgages and puts them for sale in the stock market. Okay? So the lender who originally gave you your mortgage now has been repaid and now can use that money to lend to somebody else. That's how that goes. Okay? In other words, it's the same thing as a government-backed loan because the lender's getting paid in full immediately. If you end up being a borrower that never pays one dime, the company or the mortgage company that gave you your mortgage, they've been paid in full. Okay, so Wells Fargo, U.S. Bank, whatever, Bank of America, whoever gave you your mortgage was paid immediately after you closed when they sold it to Fannie Mae. So Fannie Mae then bundled those into the stock market. Those people take the hit. But the lender was paid immediately, the original lender. Therefore, it's like government-backed. That's what it is. Okay.
Which is why you have the heightened scrutiny so that you ensure that the underlying collateral is actually in a tenable.
Because let's say the company that gave you the mortgage didn't follow, decided to just give a loan to somebody that didn't qualify. Fannie Mae could reject it. And now they're stuck with that mortgage. They're not going to get repaid immediately. So, of course, they stick very strictly to those regulations. Okay? Yeah. So, each of those has a system that lenders have access to. You, as a homeowner or a buyer or a seller or whichever position you're in, do not have access to this. Okay? So, you never see this. But the two systems, for Fannie Mae, it's called the Condo Project Manager, or CPM. And for Freddie Mac, it's called the
CPA.
The CPA, I'm sorry, the Condo Project Advisor. I'm sorry. Condo Project Manager is Fannie Mae, and I get confused. And the Condo Project Advisor is Freddie Mac. But they're both basically the same thing. Those are the system that all lenders use as an underwriting
Think of it as
guideline.
A monitoring system.
Exactly. It's a guideline thing, right? And it's each lender will likely check at least one of them, depending on who they work with the most. For example, if they work with only the larger banks and they're probably only selling their loans to Fannie Mae, they might only look at Fannie Mae's system. Some lenders do both, and they'll look at both. But it amounts to the same thing. Now, you could go online and look at the CPA or the CPM and read those standards. You can type in to Google, type in Fannie Mae CPM, and you can download a PDF and read it for yourself. But the list of HOAs that have been delisted, or in Fannie Mae's terminology listed as unavailable, that is not something that you'll find online. It's not public record. So the first time you might notice that your HOA is in big trouble might be when you try to sell your place and find out nobody that's trying to get a mortgage can get your place. And
you're really finding out from a prospective buyer.
Exactly.
Yeah.
So the fact that it's invisible to homeowners, sellers, buyers, whoever, the agents, it's invisible to them is a big deal, okay? And keep this in mind, we're not talking about, it's not like your condo is delisted. It's the whole HOA.
Yeah.
Now, there is an exception. If your condominium complex is actually recorded in different phases, then it can attach only to one phase. But we're not talking about that today, okay? Now, let's talk about who gets hurt. And this is where we get the situation, right? So Fannie Mae and Freddie Mac evaluate HOA communities as a whole. Through the underlying guidelines that they publish, and that all of the people that they buy their loans from have to follow strictly. And so a buyer with excellent credit might still find that they can't buy a condo in that community if it's been, let's say it's a Fannie Mae property, it's been listed as unavailable. Yeah. They can't unless they want to pay cash. If they pay cash, Fannie Mae and Freddie Mac don't even come into the picture. Okay? And because the vast majority of buyers of properties are not cash payers. That's
You need
pretty rare.
Financing is necessary.
You need financing, right? So even if you don't have any plans to move, you have no plans right now to sell your place, a flag on your HOA is a very devastating thing for you because your property value drops because if nobody can sell in that community, and you might not be ready to sell, but you might have neighbors that want to, if they can't, then for all intents and purposes, your property values have just skyrocketed down. I shouldn't say skyrocket. I should say plummeted downward.
Right. Yeah.
Meaning you're not going to be able to get an equity line of credit if you decide to. Your net worth has just dropped.
Refinancing. That's what a lot of folks do.
Yeah.
And so,
not now, but yeah.
It'll impair your value, but even beyond impairment of value, it really takes the financing off the table.
What basically is this is a bad way to put it, or I guess I don't know. This is a unfortunate way to put it, but it's a community-wide problem that's wearing the disguise as a failed sale, but it's a big deal. Let's talk about the 7 triggers. And by the way, this is the meat of the matter. And then we're going to be done. It's going to be a short episode. We have 7 triggers here. What causes a community, an association, to become unavailable or not eligible, to be delisted by Fannie Mae and Freddie Mac? Because remember, once you're in that category, you're out.
Yeah.
There is no sale except to a cash buyer.
Right.
Okay? So, flag 1. These are the things that the system is designed to point out and that determine whether or not your community is available or eligible or unavailable or not eligible. Number 1, critical repairs and significantly deferred maintenance. Briefly.
Yeah. No, this is at its core, it's a safety issue. If you're dealing with anything significant, to give a few examples, let's say under SB 326, significant balcony-related issues from a structural perspective where a balcony or series of balconies have been red tagged. Or you're dealing, let's say, with subterranean parking that's on the verge of collapse, or serious structural issues have been, foundation issues is a big one.
Or there's massive wood rot throughout.
Exactly.
Okay.
Exactly.
And there's evidence of significant deferred maintenance because they've been trying to keep dues low. That could get you delisted or not eligible.
Roof failures. Failures.
Yes.
Roof failures.
Exactly.
That's a big one.
Next one. 2 of the 7. Litigation tied to critical repairs. So there's a whole balcony dispute under the balcony law, SB 326, and a homeowner's filed a massive lawsuit about it. We've had lots of homeowners throughout the state of California file lawsuits on the balcony law and the inspections and all that, and the special assessments that come with them. That litigation, delist. Now, not piddly little cases.
No.
Okay, we're not talking about. It's not every litigation. It's not just HOA was sued. It's going to be delisted. No. This is litigation that's tied to critical repairs or failure or lack thereof. That's what we're talking about as the second flag. Okay. Special assessments for unfinished repairs. Okay. If a special assessment is funding a safety or structural repair and it's not done yet.
Right.
Okay. Then the project's going to get flagged or stay flagged until a proof of completion.
Right.
So if a massive special assessment, $50,000 per household for SB 326 purposes is out there, and the Fannie Mae, let's say they find out, they might delist you, make you unavailable. Because if the repairs aren't done yet, and it's not until the repairs get done until you can get off that list.
Right.
Okay.
Right.
High delinquencies. Talk to me about that.
Well,
and we're talking delinquencies in payments of assessments.
Regular dues and special assessments.
Right, not fines.
We're not talking about fines.
Forget fines.
So to the extent the total delinquency or arrears or non-payment on
the percentage of homes that have not,
15%
that are still
is the
behind.
threshold. So if it exceeds 15% of the entire community, that gets red flagged.
Hold on. That are 60 days or more late.
Exactly.
Right, okay.
60 days or longer. So that does not necessarily account for those arrears or those instances in debt where they have a payment plan arrangement.
Does not include
those. No. So to the extent the boards in those communities are making a due effort to get them back current.
No problem.
No problem.
So basically to make that third one more clear, or fourth one, fourth one more clear is if 15% of your households or more are 60 days or more delinquent in the payment of assessment, special or regular dues, that alone gets you delisted. Now, as you said, if you are under a payment plan, that does not, even if you're in arrears, but you're on a payment plan and you're part of that, doesn't count. So that's good. So as long as an HOA is acting,
Exactly.
it's gold.
In that context, you could theoretically have a lien that's unreleased. The debt is still there, but it's being serviced. It's on the right
No
path.
problem.
No problem.
No problem. Exactly right. Number 5, too many rentals.
Yeah.
Okay. So let's say you live in one of those communities where the governing documents allow rentals, whether they're allow short-term rentals or whatever. It doesn't matter. Even regular 30 days or longer rentals, whatever. Because remember, you can't ban 30 days or longer rentals completely anyway. That's against the Davis-Sterling Act. But let's say your HOA doesn't have any rules limiting the percentage of homes that can be rented within, and we've done episodes on that. I'll put a link in the description to give you the numbers on that. But point is, if your HOA, Fannie Mae's rule is 50%. So if your HOA, 50% or more of the homes are occupied by renters, that could get your HOA community delisted.
Right. And that's really about owner occupancy.
That's right.
Whether it's an investor property versus not. And if you get delisted under those circumstances, owner-occupied homes may still be eligible for conforming loans.
Now, if it's an investment property and there's no renter in it, it's just empty, that won't count toward that number, okay? It's renters.
Exactly.
Okay? Yeah. 50% or more are renters. That can get you delisted, okay? 6, weak budgets and reserves. Remember in our 2-part reserve study and many other episodes, we've talked about the percent funded number because that number tells you how healthy your HOA is in terms of whether it's going to have money to fix the critical components that have to be fixed when they eventually fail, okay? When their useful lives are over. And if that number's too low, or if the HOA is not budgeting its actual expenses properly, that could get you delisted.
And if misalignment with the reserve study, that's a huge red flag.
So Fannie Mae, its current policies expect HOAs to put at least 10% of its assessment income toward reserves. So if it collects $1 million a year total as dues, then they expect $100,000 of that to be deposited into the reserve account. If your HOA falls under that 10% figure, whatever that number is, that can get you delisted. Any one of these by itself is enough to delist. Some HOAs, especially very badly managed ones, have multiples of these. Okay, they tend to clump together. Okay, so having money go into reserves is critical, not just because a failure to do that, which I've been screaming about for months now. A failure to do that 100% means that eventually you guys are going to face a massive special assessment because the piper has to be paid eventually. The bill comes due. So somebody's going to have to pay, and that somebody's you. But in addition to that, it can get you delisted. Yeah. If your HOA is not budgeting. And that means at least 10% of all the money that it brings in going into the reserves. Now, good HOAs will put more than that. They'll put enough to cover all of its major components or close to it. And then the last one is insurance gaps. Yeah. Okay? The HOA has to carry a certain amount of coverage according to Fannie Mae and Freddie Mac standards. Okay? Now, there are a couple of laws in the Davis-Sterling Act that require HOAs to carry certain kinds of insurance. But, for example, replacement.
Full replacement cost.
Right. Yeah. Isn't one of those required kinds of insurance. Governing documents might require it. They might not. Most do, but some don't. Fannie Mae says, well, we don't care what your governing documents say. We don't care what the law requires. We're saying you better have at least coverage for 100% replacement cost, okay, for whatever, the structure or whatever, okay? Right. You've got to have sufficient coverage so that if the thing collapses, it can be rebuilt. Now, I don't know, I couldn't find information on whether or not that applied to people under the FAIR plan. Oh, so I'm going to leave that for a future fact sheet that I'll write on this issue. But I don't want to comment it now because I actually don't know. So I'm going to set that aside for a minute, okay? But it's not just 100% replacement coverage. The deductibles have to be under 5%. Remember that? and you have to have at least $1 million in liability.
Liability, right?
Okay.
Uh-huh.
If you lack any of those, delist it. Okay. So every trigger, right? Every one of the 7 triggers I just gave you traces back to a board not doing what it's supposed to do. Deferred maintenance, failure to be insured sufficiently, failure to collect, underfunding reserves. It's all preventable. It's all failures. Okay. Now, in my opinion, in almost every situation that I can think of off the top of my head, tell me if you agree. If your HOA has been flagged as not eligible or unavailable, it's a result of negligence on the part of the HOA. And in certain cases, it could actually also be breach of fiduciary duty. What are your thoughts on that?
I'm inclined to agree, Mike. I mean, it's a slippery slope that one thing, and it's a bit of a sequential thing. These are interrelated, these components.
And they build on each other.
And they build on each other, and it doesn't manifest overnight. It's usually a function of truly deferred maintenance, severe mismanagement of the financial side of things, and that's what it's about. It's about safety and money.
That's right. Yep. And here's the thing. I'm going to put a link in the description of the fact sheet that I wrote about this very issue a while ago. I'm going to go ahead and put a link in that, so you might want to read that. I go into great depth there. Now, we're going to talk about some myths, because these myths are huge. And the 4 myths that are out there, and I pulled these myths by Googling certain questions and then looking at what was available, and I was able to glean that these are the big 4 myths, okay? Your knowing that these are myths, meaning they aren't true, is half the battle. It's very important. Because remember, if your HOA is unavailable / not eligible, you're screwed. You can't sell your place unless you're selling to a cash buyer. You're just tied up. That is a tragedy and a disaster, okay? Myth number 1. Once your project is flagged, it's permanent. That is false. No. A property that's not eligible, that is unavailable, that has been delisted, can become listed again, can become eligible, can become available, simply by fixing the thing that caused it to be delisted.
All those categories are curable.
Every one of them.
Yeah.
You're not collecting enough on assessments? Get your collection efforts up, okay? You're not putting the 10% that you're supposed to put over into reserves? Start doing it. As soon as you could show, Fannie Mae, Freddie Mac, as soon as you can show that you are now compliant, you'll be listed again. It's that simple, okay? So being flagged is always a temporary situation. How temporary is 100% up to the HOA. And when I say the HOA, I mean the board. I don't mean you individually, okay? Myth number 2, HOAs can hide these problems. That's wrong, and it's dangerous, right? Because lenders are required, and when I say required, if they don't get bought. Their loans don't get bought. They don't get their money back right away. They don't want that. They want money for the next person. They want to make interest, right? So what happens? If they're required to review the documentation, that's why they are so careful in underwriting, okay? So concealment just delays sales. It causes problems. It also amounts to something called fraud.
Right, true.
Okay? Which in many cases can be criminal as well. Okay? Myth number 3, one little lawsuit dooms the HOA. No. Tell me why that.
Because at its core, it has to be something that's critical from a structural perspective, from a safety perspective, or habitability perspective. If you are suing, let's say, over the validity of assessments in itself is not going to flag you and delist you.
Right, exactly. So it has to be a significant lawsuit. It has to relate to safety or serious failure to repair or maintain, okay? Myth number 4, cash buyers make the problem go away. No, for one reason. Yeah, cash buyers can close. But what percentage of purchases are by cash buyers? Very small. The vast majority, I don't have a percentage, but the vast majority of these are loans.
Conforming loans, yeah.
Yeah. People, that's what mortgages are. Most people I know, when they first buy a house, have a mortgage. Eventually, you pay off your mortgage and then you own it outright. Okay, there are a lot of people that get there eventually, but that's not how properties are bought and sold. Right. The very wealthy can do that because they can just pay cash. Hey, I'm going to go buy an $900,000 condo. Here's a check for $900,000. Not a lot of people can do that. That does not make up most of the sales. Therefore, no.
Yeah.
Okay? The flags are all fixable. Keep that in mind, folks. Now, how do you get unflagged? How do you get fixed? make the repairs.
Right.
What else?
Provide documentation. For instance, documentation that engineers have signed off on things, that it's no longer
The repairs are done.
red tag with, let's say, code enforcement.
Exactly.
And building safety.
The dry rot is all the wood that was dry rot has been taken out and repaired.
Yeah.
Okay. You guys went through the process of doing a special assessment, hiring the contractors, paying them. The work is finished. They sign off. Get your documentation, show. You're done.
Right.
Easy peasy.
Insurance gap, provide documentation paperwork that you now have adequate coverage.
We had less than total replacement cost. Now we have total. Here's our deck page.
Yeah.
Yeah. We had a huge deductible. Now we've gotten it under 5%.
Right.
That's all you got to do. Okay. Your HOA has work to do, but it's all doable and it's all the HOA. It's you homeowners that have to make sure that those people either do it or they are replaced. Yeah. Because as long as they don't do that work, you're going to stay delisted or not eligible forever. Here's the whole picture. The Fannie Mae and Freddie Mac delisted, unavailable, not eligible flags are disastrous for anybody living in an HOA that's fallen under that rubric. You got to avoid that at all costs. And to the extent that you haven't been able to avoid it and you've been delisted, you being your HOA, then you have an obligation to work with your neighbors to get the board replaced or get them going to fix it, because it is not hard to do. Easier said than done, takes money and time, but it's not hard to do in the sense that you just got to fix the defect. If you've been delisted for 2 reasons, you got to fix both reasons, and you're done. Once you have the proof, you're over. It's very simple. If you like this episode, please hit the like button. If you haven't already done so, please subscribe to the channel HOA Hell. If you want to leave a question or make a comment, please do so. Until next time, have a wonderful day.